Investing. Boring stuff to me. I would rather be trading. Then again, I am not the king of decision making. Because it makes the most obvious sense to them, many investors have a style that they favor. And they often concentrate on that approach when creating their portfolios. That fashion has value for some. Trying to spend less for $1 of earnings or cash flow merely makes sense. However, there is a drawback to this strategy. The issue is that value isn't the only thing that influences behavior. Significant scholarly research supports momentum. Both profitability and quality are compatible. Additionally, they frequently work at times other than when value is working, which is an advantage. Combining variables that tend to function at different times and have a strong long-term track record produces a free lunch by lowering risk without lowering return. But choosing to combine different components is the simple part. How to do it is the challenging part. The two principal methods of multi-factor investing. Building multi-factor portfolios can be done using one of two basic strategies. Different people refer to them differently, but generally speaking, the first way, also known as the sleeve strategy, uses each factor as a distinct portfolio before combining them, whereas the second method uses each factor simultaneously, integration. Let's examine a straightforward example. There are two ways I could construct a portfolio of 20 stocks utilizing simply value and momentum. I may choose 10 stocks with the highest momentum ratings and 10 stocks with the highest value scores using the sleeve method. Then, to create my 20 stock portfolio, I could simply mix those two portfolios. I would search for equities with components of both value and momentum using the integration strategy. As an illustration, I may use value to rank all the stocks in my database, followed by momentum to rank them, and then I would add the stocks with the highest combined score in my portfolio. Integration can be much more difficult in practice, but that is the general notion. So, which strategy is preferable? Unfortunately, I won't be able to provide you the response you're searching for to that inquiry. When there are smarter people than me on both sides of any given dispute, one of the basic investment guidelines I follow is that there probably isn't a right solution. I believe that is the situation here. The integrated methodology. However, that does not imply that each does not have benefits. Due to the integration process taking into account every aspect, the integration approach often maintains higher average scores across the factors. Therefore, it is less likely that your value stocks will have extremely low momentum scores and vice versa. Additionally, there might be less turnover. This was covered in Sheridan Titman, Greg Fisher, and Ronnie Shah's 2016 work, Combining Value with Momentum. They provided the following explanation. Our examination of long-only strategies demonstrates how a strategy that combines pure play value and momentum portfolios that are created independently beats a strategy that concurrently incorporates both. The simultaneous strategy has two advantages. Reduced transaction costs are the first. Greater use of adverse value and momentum information in a long-only portfolio is the second. The sleeve method. The sleeve method also has benefits. It enables a portfolio to keep more pure factor exposures in each sleeve, which is the main benefit. It is likely that looking at exposures to other factors will at least partially lessen your exposure to your original factor. For instance, if I use a value strategy to find the cheapest companies and later decide to set a minimum standard for quality, the resulting portfolio will probably have less exposure to value than a portfolio without that restriction. It can also provide investors more direct control over their factor exposures, which is another benefit. For instance, I could simply use one sleeve of value stocks and a different sleeve of momentum stocks to create each half of my portfolio if I wanted it to be 50% value and 50% momentum. Ultimately, I don't believe there is a single right way to construct a multi-factor portfolio. Each approach has advantages and disadvantages. Given the significant advantages of combining several aspects, choosing to do it at all is perhaps more crucial than choosing the specific approach. In other words, just take action. Thanks for watching. If you found value here, please like, leave a question or comment below and consider subscribing.